Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. Joining me today, as always, is our Chief Investment Strategist and President, David Burrows. On today's webcast, we will provide you with a brief macro overview, and of course, look forward to addressing your questions at the tail end of David's conversation. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, I turn the conversation to David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Great, thank you. How are you?
Great. It was nice to have a week away, but good to be back and lots to talk about.
Wonderful. We look forward to your webcast, Dave. I'll let you take it from there.
Great. Thanks, everybody, for tuning in. I apologize for no webcast last week. I had a week away with my family, which was really nice. But here we are back in the saddle. So we're in the middle now of August. We have had a little bit of a relief rally over the last few weeks. I think there are lots of people who question the stability of this rally. There are others who think that perhaps we put in a near-term low and that we can rally from here. So we're going to examine that a little bit. Lots going on across various asset classes. Lots going on in the macro world and lots of things that people are thinking about. Certainly, inflation still forefront on the radar screen. We've got lots of political instability globally. But having said that, portfolio managers and investors have been repositioning for months now and have had lots of opportunity to assess the situation. So let's just take a look and see sort of what the charts are showing us. And what's showing up in Barometer investment team's work. So just really quickly, as we always do, just starting out with the big long-term picture of the market back to 1900. We believe we're in a structural bull market that started in 2013. And while there have been plenty of pullbacks along the way over the last 10 years, structural bull markets tend to last a long time. They also have a remarkable ability to absorb bad news. So we all worry about bear markets like 2000 or like 2007, 8, 9, or like 1974 or like 1929, 30, 31. But these are things that happen during structural bear markets. They tend to be paired with credit crisis or big structural risks. And at this point, they don't appear to be poking their head up. Despite the fact that it's been a sloppy year to date. If we take a look at the S&P chart, going back to 1981, we know that there have been lots of these bull market corrections during structural bull markets. And this is what it looks like to us. We've been going through so far over the course of this year. We put in a low in June. We've rallied since then. And it is within the context of a structural bull market. But we'll examine that a little bit as we go along. From a rates perspective, we have a view that we saw a structural low in interest rates in 2020. We had a very sharp rally in 10-year yields, which a couple of months ago exceeded the highs from 2019 and broke the long-term downtrend in rates that have been in place since 1980. So very, very important and something that we had been looking for, believed that we saw a generational low. And that being said, once those things happen, very often the market will have a way of retrenching. And we've certainly seen that. We've seen yields over the last couple of months touch highs and then come back down into declining moving averages, which would be very normal. Market may chop around here for a bit, but certainly, after being short bonds for many months, covered them a couple of months ago, may look at starting to layer back some shorts here, depending on economic activity. If we take a look at the economic surprise index, we saw it weaken through the course of this year, get to extreme oversold, and we've started to see a little bit of a turn or a little bit better economic data coming in versus expectation. Doesn't mean that the data is getting a lot better. It means that expectations have become really negative, which probably means investors and portfolio managers have built in the idea of some really negative economic data. And we're getting slightly better data coming in over the last few weeks versus expectation. And that may well be that yields can find a floor in here and start working their way higher. So not ready to add a lot of bond positions, obviously. We've had some short-term bonds as a safety play and started to let some of those go, but we'll talk about that as we move along. On commodities, we've had a view that just like in 2000 or back in the early 70s, we saw a structural shift of outperformance of commodities versus equities. It tends to happen at a time when commodities become universally hated, which certainly they were a year ago after 10 years of underperformance. And we've seen that turn. And I think that probably this is here to stay for a while. This is the RJI equally weighted index of commodities. And after being in this long downtrend since 2008, and in fact, relative underperformance going all the way back to then, we saw a nice turn last year. Now we saw a little pullback over the last couple of months. Very normal. Things don't go straight higher. And in fact, as the market accelerated to the downside, commodities seem to hang in reasonably well. If we take a look at that on a daily basis, we can see that they came down to the 200-day moving average and held in. We've made a series of 4 higher lows since then. And if we look at it on a year-to-date basis, the RJI index still up 20% on the year versus certainly sloppier equity markets. So this commodity index is in fact outperforming stocks, even though we had a 14% pullback over 35 days at the end of the equity sell-off. But I think despite lots of concerns about economic activity, the structural shortages that we've been talking about appear to be holding up. And it appears that commodities can continue to outperform, which has important implications because these are small sectors in the market in general and really are under-owned and unloved. And if we can find a floor in here, could make a significant difference to portfolios over the course of the next couple of years cycle as we come out of this correction. If we take a look at oil, this chart here looks a little different than the WTI near-term futures because this is an ETF made up of near-term futures out over the next number of months. And we know that over the longer-term futures, prices have been holding up while near-term futures have been coming down. So I like to look at this ETF. We're holding above the 150-day moving average, above the 200-day moving average. And again, despite a 14% pullback over 70 days, still up sharply from early in the year. So this is Brent. WTI pulled back a little bit more, but again, still holding long-term trend. You know, it's probably the strongest trend in this market. And, you know, all of this, despite the fact that we've had these massive sells, monthly sales of barrels of oil out of the strategic reserve. If we take a look at storage, crude storage with the strategic petroleum reserve, this is 2022. One of these things does not look like the others. Hard to see how pricing moves a lot lower in the near term, but certainly structurally we are into a shortage, and that comes at a time when there's been very little by way of new investment in drilling. Natural gas holding in better certainly than oil, again above the 50-day moving average, above the 21-day moving average. Here we are in the middle of summer when we should see weaker prices for natural gas. We wonder what these might look like in the course of the winter, and that's not even looking at European natural gas prices, which of course are much, much higher due to the conflict in Russia and Ukraine. The agricultural commodities have held a series of higher lows. They continue to look attractive. So in our view, this reflationary trade, despite concerns of what the Fed may do to economic demand, continues to be in play. Now, we have opinions about what should happen, but our decisions are made by what is happening. And so just from a process standpoint, just to remind you, we are governed by a process that takes a look at all of the investable universes we could focus in. And that's asset classes like bonds and equities, or global equities or emerging markets, or commodities or real estate. And we try to identify those buckets that are seeing net new inflows of capital. Where is the leadership? And within those groups, we try and find specific securities that meet our stringent tests, which are both fundamental and technical, looking for the strongest securities we can find. We look at, over 30,000 securities daily, but we're looking for a basket of securities as 20 to 30 investments when we're fully invested. And so we're trying to identify strong candidates that are good getting better in parts of the market that we care about. All of this governed by our breadth models. And the premise is, in a strong market over time, a higher and higher percentage of securities should participate in a rally. And when breadth is expanding, it means the market's robust. It can absorb bad news. When breadth is deteriorating, or fewer and fewer securities are performing well, it means that there is elevated risk. And despite the fact we may be in strong securities, they could be the next ones to fail. So our job isn't to be everywhere. It's to be in leading sectors and themes. We want to always look for new leadership to emerge. And in the absence of leaderships, have a willingness to sit on cash. So it is a tactical approach. We're never going to be everywhere. On June the 29th, virtually all of our short and long-term indicators had been weakening. And as a result, we had a significant cash weight and a significant holding in some short-term bonds as a placeholder to be defensive. At that time, we highlighted, though, that the percentage of portfolio managers taking higher than normal risk was at the lowest level since 2008. In other words, lots of caution in the market. We highlighted that futures positioning, again, was very, very defensive. We highlighted that cash positions were as high as they've been at the worst points of sell-offs going back to 2000, and that sentiment was extremely bearish. We talked about the fact that July often is a month where the market has some relief. And we talked about the fact that in the S&P, the percent of stocks trading above their 50-day moving average, or short-term measurement of trend, had gotten all the way down to 2%. And that when we looked at the occasions where that had happened in the past, they happened at extremely negative moments in the market, and most often resulted in, over the next few weeks and months, quite positive returns for the market. Now, arguably, we were looking at some very negative commentary from economists, real concern about what the Fed would have to say at the next Fed meeting, and would they raise 75 basis points. We're concerned about what's going on in Ukraine and Russia, concerned about what might be happening in Taiwan. There was lots of things to worry about. On the week of July 29th, we said, there's three important things we're watching this week. We're going to have a very busy week or two of earnings reports. We're going to get a Fed decision, and we may get a GDP report that shows that, in some people's view, 2 negative quarters of GDP growth would be deemed a recession. Well, from an earnings perspective, with almost all companies reported now 2 weeks later, average sales growth for the quarter was 14%. Of course, energy led the way with 77% revenue growth. And the weakest group was communication services, a sector actually that's been underperforming now for over a year. Earnings growth came in at about 8.8%. And if we look at how that all came in versus expectation, sales surprise for the average company in the S&P was about 3%, and the average company beat earnings estimates by about 4%. So by all counts, in general, companies came in ahead of expectation, showing the resilience of many of the largest US companies. On the other hand, GDP growth did come in as negative. Inflation data came in a lot hotter, and the Fed raised 75 basis points. So you might think that that might be a major problem for the market, but what's happened? The S&P has come off these lows and rallied nicely over the last couple of weeks. So some relief. The question is, where to from here? We have some resistance back from June, which we're struggling to get above. We've got a downward trending 200-day and 150-day moving average, and there's a downtrend line from December through the March highs that comes in around the 200-day. These are all going to pose some resistance for the market. May take some time for us to get through. We know that August and September and the beginning of October often are sloppy periods. So there's a couple of paths from here. We may have a V bottom in the market, which does happen about 50% of the time. We may have a retest of the lows in the seasonally weaker periods of September and October. But in the near term, we're governed by what's actually happening in the market. And when we look at that, the breadth models are solidly green. This is as of today. So if we take the Canadian market, roughly 43% of stocks are now in uptrends, and that has been rising. So the percent of stocks behaving constructively has been improving nicely. Percent of stocks in the NYSE that are in uptrends comes in just about 60%. Percent of stocks globally in uptrends comes in just about 50%. All of these up smartly over the last 6 weeks. From a short-term perspective, we can see that in the NYSE, almost 70% of companies are now trading back above their 50-day or short-term measure of trend. Percent of stocks with positive weekly momentum are trading 80% with positive upward momentum. Percent of stocks making new highs versus new lows also expanded. In fact, every one of these indicators has shown improvement. So on the ground, what's happening is people are putting some money to work. We think that people got exceedingly pessimistic. Now, the difficulty will be what happens from here. In some ways, we'd love to see market pull back a little bit because we'd love to know what is it that holds their gains and what is it that maybe was short covering that would sell off again, and that remains to be seen. What we do know is that the concerns around credit have started to come off the boil a little bit for high yield and for corporate credit, that spreads widening or the extra return a bond investor was demanding to buy corporate credit versus government credit didn't get anywhere near where we went 2020. And that's without looking back to 2008, which lots of people want to compare this market to, which had much wider credit spreads. So credit spreads are not showing us that we have some kind of credit problem, certainly not at this point. If you looked back to 2008, that people like to compare this market to, or 2000, credit spreads were much wider and did indicate a potential credit problem, which is what caused the market to go from being down 22 or 23 to being down 45 or 47%, which the bears like to point out is what they think might happen. But at this point, breadth models are constructive. Credit spreads getting a little better. If we look at volatility, this was the spike in volatility in 2020. This was the first spike in volatility as the market started to sell off this year. We've seen lower highs in each one of the sell-offs, and we're back down into a much more normal range. So our job isn't to forecast. Our job is to monitor and have quantitative tools to recognize change. And what all of these are saying are things are getting better. Now, that's not for everything. Some groups acting better than others. And when we look at the sectors, we know that in the end of June, on June the 23rd, if we took all of the sectors and stacked them on a bell curve as to what percent of stocks within each of these groups were performing well, we can see almost every sector in the US market had very few stocks in uptrends. The ones in small letters means that the breadth had been declining. Now, as we sit today, it's a different picture. First of all, you can see virtually every sector is in capital letters, meaning the percent of stocks in uptrends has been expanding. Remember, no bear markets in history while breadth was expanding. So we monitor this daily. We can see that lots of sectors have between 40 and 60% of companies within their groups performing well, meaning there's some good ones and there's some not so good ones. Now, we don't need to own everything. A portfolio for us is 20 to 30 securities. Our job when the market starts to firm is try to identify those that are behaving better than the rest, those that have stronger fundamental characteristics and price behavior that shows us that the market believes what the numbers are telling us. And then we monitor. So it means that we've got a broadening market. It means that over time, more and more stocks are participating in the rally. So long as that's the case, we can stay constructive. If things start to change, either at the sector level or geographically, or large cap versus small cap, we can always make change. But if this is a correction like other bull market corrections, we need to be invested as things are improving, not following the headlines in the newspaper, which will never tell us when to put the money to work. So if we see deterioration, we'll get more cautious. But at this point, that's just not the case. So let's talk about leadership for a minute. So far over the course of the year, energy has been the leader. This is a chart of the Canadian Oil and Gas Producers Index. I highlight here from the beginning of the year, oil and gas index is up 34% over the first 157 days. Certainly it pulled back some through June and into July. We know that late in a sell-off in the market, even the leaders generally will get hurt, but it held at the 200-day moving average. And despite oil being a little choppy, we're working our way higher, and still relative performance of the group is stronger than 94% of all of the constituents in the S&P 500. So we always worry that higher prices might impact demand, but we believe that there is a structural deficit. In fact, despite the fact that prices have been higher, there's been almost no response in energy capital spending. That's not going to fix a structural problem. When we look at oil and gas equities performance versus tech stocks, we highlighted a while ago, we saw a relative turn that is about the same as what happened in commodities versus the S&P since 2000. And the last time this happened went on for a long time. So we'll see. But at this point, Brett is positive. Price behavior is good. And other groups within energy are acting well. Specifically in the last few weeks, solar, after correcting through the course of the last year, has made a nice turn and reversed upward. This obviously has to do with the legislation in the US for clean power, but these are companies that we have some exposure to. Next theme is dividend payers. Now, we've talked about dividend payers being stronger than the market through the course of the year. In fact, the FDL ETF, which is made up of dividend aristocrats, companies that have a history of raising their dividend, is up a little on the year versus quite a negative market. This is made up of a number of different sectors, but the dividend theme is alive and well. The utility sector, shown here by the FUTY ETF, is just very close to making new highs and trading better than 87% of the companies in the S&P. The consumer staples ETF has held in very nicely as a defensive position and a dividend payer. And so the whole dividend theme continues to work well. What else is happening? Over the last few weeks, we've seen a marked relative improvement in industrials, but it's really led by the groups that we've talked about previously, which is aerospace and defense for obvious reasons. From a basic materials standpoint, after correcting sharply, the materials, the metals and miners has turned back higher. Relative strength has now been improving since the end of June. We're trading back to the 200-day moving average. We'll see whether it can trade through, but still this group is up 7.5% on a year, where stocks in general have been weak. When we look at the point and figure chart for the XME, you can see the strong run up in prices into June of last year, consolidated through the course of the summer, had a second move up into the spring of this year. We corrected back into this breakout and now putting in a series of higher highs and higher lows. This doesn't look like recession to me at this point. I think the market may be telling us something different. Metals and mining stocks are very inexpensive relative to the rest of the S&P. In fact, they're trading as cheaply on a multiple basis as they were at the worst point of the 2008-2009 bear market. Groups that we really don't own continues to be the consumer discretionary as a group is relatively underperforming. It had a nice bounce over the last few weeks, about 10%, but on a relative basis, not gaining any ground versus the S&P. And the same picture for the communications group. In fact, very close to making relative strength new lows. So the market is broadening. We are seeing some improvement in where money is getting put to work. We maintain a strong position in the energy sector, but you can see we've started to take down some of our defensive positioning. About 11% of firm assets are in short-term government bonds. Again, that's a safety trade. I think we're at an important level in the market where we're going to get a sense for whether we're going to follow through or whether we may get some seasonal weakness. But we don't want to make a one-way bet. We've raised our weighting in utilities, financials, and consumer staples, all three being significant dividend payers. Industrials, led by the defense stocks, we've increased our weight to 10% because we're also seeing strength across some of the additional aerospace sector. Technology, while it still lags on a year-to-date basis, had a better last 2 or 3 weeks. There have been some selective places to add some exposure there, although as you can see, we still have a significant underweight position versus market, because our guess is that technology as a group is still relatively expensive and would be hurt by rising rates. Healthcare as a defensive sector came down a little bit. Corporate bonds came down a little bit as we used some cash, and we still have about a 4% cash weight. We continue to avoid communications, consumer discretionary, and real estate. So the portfolio is more forward positioned than it was 2 months ago. We still have lots of flexibility in that we have some cash to use as we work our way through August and September. We've got some really strong individual positions, which we're going to talk about on next week's call. But now we're at a point where we need to see where the rubber is going to hit the road. This is the declining 150-day moving average. We're traded right up underneath it. We've traded up to where we traded to in June, and we're sort of in a sideways consolidation. The short-term moving averages have turned higher, and we know breadth is improving. So there's two paths. One is that we retest lows or retest the uptrend over the next few weeks, and we have some cash to take advantage of that if that's the case. Should the market follow through the highs from June and back toward this 200-day moving average, and should more leadership show up, we've got flexibility to put new money to work. But the path forward is going to be dependent on a number of different things, and we're at a seasonally less liquid period of time in the market. So we'll see. The long-term picture, though, is much clearer. When we come out of these short-term consolidations in a structural bull market, it tends to be you get 1.5 to 2 years of significant rally going forward. To put it in perspective, the bull market of the 80s and 90s gave a 1,200% return over 216 months. Since the beginning of this bull market, it's 172% over 114 months. We potentially have a long way to go. We don't want to get too negative when we read the news. We've got to look at what's actually happening in the market. Our guess is investors are generally underinvested. They are very, very defensive. There's been lots of news in the market over the last year to make them concerned. But there will always be opportunities going forward. Our guess is it's most likely that there is a reflationary cycle in front of us. As I talked about before, in the 1950s, after the Second World War, 1949 and 50 were years of high inflation, as there was a mismatch between supply and demand, which was cleared, and then the market rallied over the next 10 years. It may be we are in the process of seeing some of these things clear now. In the meantime, we'll continue to look at each individual position daily, run our stop losses, and if things were to get weak, we're pretty good at playing defense. We can do that. So with that, Pam, if there's any questions, certainly happy to answer them.
Thanks so much, David. We do have a couple of questions. Jeff wants to know, David, what is the most efficient way to overweight a portfolio of equities and mutual funds to an exposure of all commodities without buying a basket of ETFs that track many different commodities? It's a thick question. I'll let you speak to it. And if you need me to
Well,
repeat, I would be happy
it's
to.
probably a longer discussion. We can get exposure to specific commodities using buying equities that produce those commodities. That's one way. And you have to keep in mind, in some ways, those can be a more leveraged decision. When you're buying, say, a copper producer, you're not just buying the earnings that are attached to the current production, but you're buying, a call on all the copper that they have in the ground. So very often a move in price doesn't just reflect in the earnings, it reflects in the value of their holdings. We can target individual commodities using specific ETFs that are specific to that commodity. And of course, individuals, if they so choose, could look at trading options or futures contracts on those things. So it's a longer conversation. I don't think that any of these things are a one-way bet. I think that we have to have a diversified portfolio and find ways to get exposure without taking too much risk. So happy to have a one-on-one conversation if that would be useful.
Absolutely. Thanks so much, David. Jeff, let us know if you want to chat further. Sebastian needs to know a little bit more about crypto, Dave. He is asking, David, what do you think about crypto? Do you think we've bottomed? And if so, would you recommend Ethereum?
Yeah, it's very interesting. It does look to me like we've put in a near-term low. Ethereum, as you know, has a halvening come up. There's going to be a hard fork where a new version of Ethereum format will be going forward. And it looks as though, despite lots of bad news and a couple of blowups in the cryptocurrency arena in the month of July and months of July and June, they were able to find a low and rally off it. Very often late in a sell-off, you mark a bottom by a couple of big spectacular blowups. And I think probably we've seen that. If I take a longer term picture, let me see if I can put this up on the screen. So this is a longer term picture of ETH. Make it a little bit longer. Okay. So you can see we basically pulled back to a 200-week moving average here at about $1,000, and appears to be trying to trade off it. We'll see, but certainly looking a lot more interesting. There's going to be time where we're going to take to get through some of these moving averages. Probably there's some consolidation, a lot like equities. You're into the June kind of resistance here, so we're going to have to see whether in fact we can get up and through there. But it didn't take long to go from $1,000 to almost 1,800. If we do get this hard fork, it means that the supply of new Ethereum coming into the market will dry up, because they'll be going from proof of work to proof of stake, which means there will not be as much Ethereum created in the proof work. It also means that that there will just be that we're going to start burning Ethereum on each transaction. So in other words, it will be deflationary to the amount of Ethereum in the market. So it's a longer conversation, but I think that it looks like these cryptocurrencies, so the major ones, Bitcoin and Ethereum, have found their lows and maybe starting a new bull market. But I think there's a little bit more work to be done.
Thanks so much, David. Well, that concludes the questions we've received this afternoon. So I will leave you with the final word. And of course, we will see everyone at the same time, same place next week. Thanks,
Look,
David.
I think the thing that I would point out is we are in August. And I know it's been a busy summer, but we are in August. It's a month where there is less liquidity in the market. It's a month where analysts are looking at their estimates for the year and questioning whether or not their companies are going to make their estimates. The reason that we often see weakness in August and September is that that's when an analyst may throw in the towel and say, I may have been too aggressive in my estimates at the beginning of the year. And when estimates come down, that can have an impact on the companies. So we want to watch that. We want to watch estimate revisions. Of course, we want to watch the Fed and listen to the rhetoric. But the most important thing is to watch what's actually happening in the market. It's not the news that matters. It's how the market reacts to the news. And I do think it's very positive that despite some really bad news, this market has been able to hang on and rally against it. Keep in mind that investors in general are really underweight equities. And certainly lots of people got shaken out of their commodity positions. The fixed income markets improved a little as a safety place, but long-term, the trend has changed. So positioning is going to be important as we come out. I think that if we get some weakness over the next few weeks, which I would welcome, because it will give us a chance to see what holds up and what gives back gains. When the market makes a low, it's important on the first pullback to see what was just short covering and what was real buying. Because often if the market retests a low, there will be a whole group of securities that don't come close to going back to lows. And that gives you very good clue as to what is going to lead the next leg of the bull market. So we think we have an inkling of what that looks like now, but we'll test that over the next few weeks. And everybody should test that. If you have securities that sell right back off again, it means they likely, don't have strong sponsorship. And leadership emerges over a period of weeks or a couple of months off a market low, and it's important to watch for that. So that's what we'll be using our tools to do, and the investment team is going to be busy here through the month of August. If anybody would like to talk about their existing positions or portfolios, don't hesitate to give us a call. We're available. And Pamela, thanks so much for moderating again.
Always a pleasure, Dave. We'll see you next week. Thanks, everyone.
Okay. Thanks, folks.